Hello everyone, welcome back. In today's video, I'm going to be speaking about two ETFs that you can pair with SCHD to make the best investment combination. And if you do enjoy content like this, please consider subscribing to the channel for future content. And if you did enjoy this video, please consider liking it. So when it comes to ETF pairings, you could basically go two separate directions. So you could go a direction where your intent is pure income, and then you can go to a direction where you want growth. So in my dividend portfolio, I went for an income combination. And the way my portfolio was weighted, I have weighted 60% SCHD and then 40% JEPI. I am going to assume that you are going to have equal weighting. So I'm going to assume that you're going to be doing 50% the growth ETF or 50% the high yield ETF. So in this case, I do have 40% JEPI. I am going to be assuming that you will be using 50%. So the first ETF that I'm going to be speaking about is JEPI. It is about income instead of growth at first. So this is an ETF that you would use if you want high income, and you can pair this with SCHD. And I'm going to get into why this is a great ETF to pair with SCHD. So I'm going to assume you already know quite a bit about SCHD if you're looking to already pair it with an ETF. Maybe you already did the research on this ETF or you already hold it. But just to quickly recap, the fund's goal is to track as closely as possible before expenses the total return of the Dow Jones US Dividend 100 Index. And basically what this index does is it tracks dividend paying stocks that have a record of growing their dividends and then runs them through a bunch of financial ratios to pick the best dividend stocks out of the group. And basically what you get is these top 10 holdings here. It's a very diverse ETF. You see it has many different industries like pharmaceuticals, tech, you have some retail like Home Depot, more tech, energy, communications, and so on and so forth. Very diverse ETF overall in regard to industry. It does have 100 holdings, and these all basically pay a decent dividend that has a high growth potential in regard to dividends. So this is more of a dividend growth slash dividend yield ETF, and it doesn't really go a separate way, which is you have dividend growth ETFs like VUG, which has the intent to basically select dividend growth stocks, and then you have high yield ETFs like SCHD that has the intent of picking high yield just dividend stocks. So they pay a high current income, but the holdings don't really have, in regards to dividend, high dividend growth over time. And so the first ETF that you can pair with SCHD if you want income is an ETF called JEPI. And long form, that is the JP Morgan Equity Premium Income ETF. The great thing about this ETF too, if you're an income investor, is that it does pay monthly. And of course, it does offer a high dividend. So pretty much the premise of this is that it uses basically a type of option strategy that more pays so as a coupon rather than strictly options income like a typical covered call. This fund uses something called equity linked notes to produce income instead of a conventional options premium. So what you receive instead of options premium looks more so as a coupon rather than it does a premium from like a covered call. So it's a very slight nuance, but there is a difference there. I'm not going to get too much into that because you could basically go on to YouTube and watch videos with these investment managers that will describe it in greater detail. Basically, I just want to say that the majority of the way it makes its income is through these exchange-linked notes. And so the long form of the way this portfolio works is that it basically makes income from two separate places. It makes income from the exchange-linked notes as a coupon payment like I just previously discussed, and it also makes income from dividend stocks. So it generates income through a combination of selling options and investing in US large cap stocks, seeking to deliver a monthly income stream, associated option premiums, and stock dividends. It constructs a well-diversified, low-volatility equity portfolio through a research process designed to identify over- and undervalued stock with attractive risk and return characteristics. and the intent is to deliver a significant portion of the returns associated with the S&P 500 index with less volatility and monthly income. So in the most basic premise, it selects stocks, large cap stocks with low volatility, and it also receives income from the exchange link note that it writes, and its intent is to perform basically in line with the S&P 500 with less volatility, and you get monthly income from that. And so we can see from the descriptive fund literature, we can see that approximately 1 to 2% of this fund's income comes from the dividends of those large cap stocks that it holds, and the majority of it comes from that options premium as an exchange link notes, and that comprises the majority, about 5 to 8% of the income you receive. So this is more so of an options premium ETF rather than a dividend ETF. And the thing about options premium is that when there's higher volatility environments, there's going to be a higher premium that you receive. So when the market is very choppy, it's going up quickly or down quickly, you are going to be receiving more premium in those environments rather than when volatility in the market is low. Now let's take a quick look at the top 10 holdings. So this ETF basically picks a well-diversified number of holdings based on industry. And again, it is screened for volatility. So these are large cap, pretty low volatility stocks that in general, some of them do pay dividends, some of them don't. And they are very close in weightings, especially at the top 10. And for the top 10, we just have a brief overview. We have Microsoft, Amazon, Progressive at the top 3. And then all the way down at the bottom, we have like Visa and Adobe. We have MasterCard. And just overall, a great group of stock listings. Now, part of the reason why JEPI pairs so well with SCHD is that there is very limited overlap with these holdings. So we look at these top 10, and if we quickly look over to SCHD, we look at the top 10 of SCHD, and you don't see that I see doing a quick glance any comparable holdings that both funds hold. So when you invest in JEPI and SCHD, you're either further diversifying your investments to a broader number of stock holdings. So quickly look at this fund, this top 10 fund page of SCHD, and then look at this and you'll see pretty much no overlap, and that is great because it greater and further diversifies your investment. So again, this ETF here, JEPI, is great to pair with SCHD too, especially if you want income again, because there's going to be a growth ETF coming up that I'm going to be describing. So if you want income, you're going to want to pair it with JEPI instead of the growth ETF. And the reason why you want the ETF for income is that it does pay a very high yield too, and it does pay monthly. So we see the payment date here, it pays around the first week of every single month. And we do see that the amount does change depending on the month. And again, that is because of that options premium. The income is based on volatility. So again, when volatility increases, you're going to get paid more. When volatility decreases, you're going to get paid less. But you are going to get paid monthly, and even in low volatile months, you're still going to be making a decent amount of premium, above 5 to 6% in income, even in low times. So you're going to get the great diversity of holding SCHD along with the dividend growth companies, and you're going to get the high dividend yield and monthly income of holding JEPI. And again, there is very little cross diversification, or very little holding overlap rather, that these two ETFs have. So you're going to be very diversified. You're going to get that dividend growth element from SCHD, and you're going to get that really good income element in both regards to yield and payment frequency from JEPI. So in terms of performance, I did a back test on Portfolio Visualizer using SCHD and JEPIX, which is basically the mutual fund version of JEPI. And I'm using the mutual fund version of JEPI because it has a longer history. So it's going to give you a bit of better idea of how this strategy performs over time. And I set them to 50% each, so equal weighting. And to compare these, I used VYM, which is kind of like the standard high dividend yield ETF that investors will buy for high dividends. So I could use something like VOO, which is the S&P 500. But if you're looking for income, you're really not trying to perform with the S&P 500. You want to perform more to conventional dividend strategies. That's why I'm using VYM instead of something like VUG, because that's more growth, diversified growth, rather than it is dividend. So with that, we have a back test from January 2019 to December 2023. And if we scroll down, you could see that this portfolio combination outperformed the Vanguard High Dividend Yield ETF by a decent amount. It offered two at the same time, less volatility, a slightly worse year, but a lower max drawdown. And again, it is less volatile, so you're going to have a lower standard deviation. So this combination here, again, it's very powerful because you get that benefit of that dividend growth kind of growth that SCHD offers, and then you get that high dividend yield that JEPI offers and that payment frequency. And it outperforms something like VYM, which is something that investors use to invest for income. So this strategy itself outperforms to a back test, at least from 2019, these income investments that investors buy for dividends. And we can go and look at like other ETFs too. So we can look at something like a really high income ETF, something like QYLD, and do a back test. So here we have the back test versus QYLD, and it absolutely outperformed that by a wide margin. You have a little bit more than $3,000 difference. The good thing is that I guess QYLD did have a lower standard deviation, but it also had a lower worst year and a bigger max drawdown. So it does seem to underperform when times are good and also underperform when times are bad. And it just doesn't grow as well as that 50-50 split between SCHD and JEPI. So I think it kind of goes to show that this 50-50 combination outperforms like even conventional dividend ETFs like VYM, and it outperforms like really high yield income ETFs like QYLD. So that is part of the reason why this combination is very powerful. Again, you get that growth from SCHD and that income and volatility reduction from JEPI. So next up, we have investors that might, instead of income, they want growth. So for the growth ETF, I think the Vanguard Growth ETF VUG is a great pairing with SCHD, and I am going to get into why. So the fund basically seeks to track the performance of the US Large Cap Growth Index. I'm not really going to go into how that index is created or what constitutes it, because it is pretty described in the name. It tracks a list of stocks that are considered growth. So they have growing revenue, growing income, growing cash flow. Hopefully they're basically conventional growth companies. And I think when you look at the list of holdings that it tracks, you're going to see, okay, yeah, that's a growth company. It is defined as a growth company. You can't really argue that these really would be considered growth companies for the most part. So here we have the top 10 holdings here. As I said, these are going to be all considered growth companies basically. And when you look at the list, this is going to look very tech heavy, and it is, but keep in mind this is going to track all like growth companies. That's why you see like Visa here and Eli Lilly, even though they're not really tech companies, they are considered growth companies. And we take a look at this list here, and again, like this is going to be an added diversification when you pair this with SCHD, because we're going to take a quick look at this and we see Apple, Microsoft, and Amazon, Nvidia, Google, we have Meta. more Google, Tesla, Eli Lilly, and Visa. And then we're going to take a look at SCHD, and you're going to notice there is no holding overlap with these top 10 at least. I'm not sure if there's one or two holdings throughout either ETF that may overlap, but overall, there is very little overlap between these two ETFs. And again, that is an added benefit because it diversifies your investment combination. So you're going to get the dividend growth and high yield, semi-high yield of SCHD, but you're also going to capture that growth aspect of the market with VUG with its holdings. Now, so I did a back test again, just like previously, with 50% SCHD and 50% VUG. And the good thing about this is that VUG was around for a lot longer. So you get a longer historical performance of how this performs in various market conditions, at least for the past 11 years. And we are going to scroll down. I did pair this instead of against VYM like before. I did pair this against VOO, or the fund that tracks the S&P 500, because if you are more wanting growth, your comparison will probably be more in line against the overall market like the S&P 500, rather than it's going to be with a high income ETF for dividends like VYM or QYLD. So scrolling down here, we do see that the portfolio did outperform over the time period by approximately $4,000 or so. It did have a greater yearly return on average. A less standard deviation. It had a similar best year, and it had the exact same worst year. Slightly worse max drawdown, but overall performed better over the time period. So if you're intent, if you were basically like stacking your two ETFs together and then seeing if they outperformed the S&P 500, this combination did so. The combination of that, higher dividend growth selection method of SCHD plus that higher growth selection method in regards to growth stocks that VUG had outperformed the S&P 500 over this time period. So based on that, these two pairings, these two ETF pairings completed its basic thing because it outperformed the S&P 500. It offered greater growth, and again, it offered some pretty good diversification overall with that dividend selection and that growth selection that you have. So you're going to get the growth of the ETF VUG plus those dividends of SCHD at the same time. So you're going to be getting pretty good growth and pretty good income at the same time, which is great. And I do want to put some various disclaimers and I guess thoughts before we close out. So this is going to basically vary, of course, with your weighting. So me personally, I don't do a 50-50 split. I am a little bit younger and I do hold two other ETFs that I did make videos about before. That is VIG and QQQ, which is a growth ETF and a dividend growth ETF. But in my high income kind of dividend pie, I basically have the weighting set to 60% SCHD and 40% JEPI because I want more so a growth aspect that SCHD offers rather than the income aspect that JEPI offers. And I'm okay with the less dividend. Overall, I do get paid a pretty substantial dividend monthly based on that dividend from JEPI, and I also get that growth from SCHD because, I don't really mind a little bit less in income, and I have those other kind of growth holdings too that I invest. Most of my money goes to that combo of VIG and QQQ. So this is basically going to vary. And there's also, many other holdings that you can pair with SCHD. So hypothetically, if you did want high growth, you can go with something like QYLG, which is also a growth ETF because it sells covered calls on a NASDAQ. And that is basically your underlying is the NASDAQ. And you also get that income of the covered calls it sells. Basically, that selection method is a bit different. You can also do like QYLD, which is really high dividend yield, and that will offer even greater income. Of course, I don't really like either of those two selection methods or investment methodologies, so I don't invest in that. But if you really want high income, I guess you can like look at those two, but I don't, again, because I just don't like that methodology. And for the pairing of SCHD for a growth ETF, you can also go with QQQ, although that just kind of covers the NASDAQ and it doesn't look at the whole market, which is why I instead paired it with VUG. I think that diversification aspect is a bit better than just holding QQQ, which tracks the NASDAQ, because VUG looks everywhere. And that is also an option for you if you are looking for growth. So that is going to be it for today's video. I hope I gave you some insights on some ETFs to pair with SCHD. I didn't really speak about SCHD, of course, because I assumed going into this video that you already knew quite a bit about it or that you already held it. I just wanted to basically show you some ETFs that you could pair if you want greater diversification and if you want more maybe growth or income. So thank you all for watching. Again, if you did appreciate this video, definitely leave a like and subscribe for future content. And everyone, have a great day.